Markets in Asia ended in negative territory, dragged down by hawkish comments from some Federal Reserve officials. Escalating geopolitical tensions also put a dent in risk sentiment. A holiday in China also made for thinner trading conditions. Tokyo's Nikkei fell more than 2%, pressured in partly by a stronger yen. Hong Kong's Hang Seng Index edged 0.6% lower. U.S. stocks ended sharply lower yesterday as Fed officials took a cautious approach in comments on the outlook for interest rate cuts. It's all eyes on the jobs data due out later, which could give more clues on the labor market and inflation. Investors also weighed in comments by U.S. President Joe Biden, who called for an immediate ceasefire in a call with Israel Prime Minister Benjamin Netanyahu over the Gaza war. The Dow Jones Industrial Average fell 1.3%. The S&P 500 losing 1.25%, and the Nasdaq dropping 1.4%. To give us more perspective on the markets, we are joined by Patrice Rousseau, who's the Chief Investment Officer at Ashburton Investments. Patrice, thank you so much for your time. I mean, I suppose I described the sentiment that is out there, but when you look back at the week, how are we faring ahead of that crucial jobs data?
Yes, good afternoon to you, Nastasia, and to all the SABC viewers. As you've already mentioned, the U.S. market closed quite deep in the red, with the Nasdaq also experiencing a bit of a sell-off, with Nvidia almost down 3%. It's all about the job numbers, as you mentioned. We had a very positive surprise the previous month, where the U.S. economy delivered 275,000 jobs versus an expected number of 200,000. So that was quite a beat. So the issue right now, Anastasia, is that strong jobs numbers means that the economy is extremely strong. And actually, it means that the Federal Reserve is unlikely to cut interest rates as early as was expected. If we go back a few months, the expectation was that the Fed would cut rates this year six times. I think it's 5 or 6 times. And right now, the expectation is that the Fed will only cut rates maybe 4 times starting in June. So it's a bit counterintuitive that strong jobs actually is seen as fueling hourly earnings and wage growth to an extent of about 4%, which means that it will be harder for the Fed to reach its 2% inflation target.
In an environment that you've just described, where we have a U.S. economy that still seems to be powering through, the question then is, does the Fed then need to cut if we have a strong U.S. economy?
Yeah, it's a very good question, and I think this is the conundrum. You have high inflation on the one side, which is so far, but I would say if you take core inflation 4% versus their target of 2%, there's still a bit to go. On the other hand, yes, there's an assumption that the U.S. economy is going to slow down in the second half, which requires the Fed to ensure that growth remains at elevated levels. So the Fed's got a dual mandate. They want to reduce inflation, but they want to also keep growth high. So your question is entirely valid. I think at this point in time, looking at the data where it is right now, there's no indication that the Fed should be cutting rates. Definitely not early, definitely not 4 cuts, but this is why the payroll number release is an important one as an indicator of the health of the U.S. economy.
Next week, we have We Buy Cars, which is listing on the 11th of April. What's the one thing that you're going to be paying attention to in relation to that listing, as well as transaction capital?
Yeah, in the case of We Buy Cars, as the viewers may know, they quite an important player in the used car market. They've already raised about 750 million rand through private placement with specific investors. They're going to be listing another chunk of shares in the market. It's not a company which is directly comparable with the other vehicle dealerships that we see. It's very niche, the used car market. I think this will be an indicator of the type of demand for SA Inc. shares. And it'll be important to see in terms of how oversubscribed or what type of demand we get when the shares list. So it's going to be an interesting one. It's the range, I think, in market cap that this company will be at could be anywhere between 3 to 5 billion rand. So it's going to be solidly in the I would say mid cap sector.
Let's talk about Sasol, because it's quite interesting to see those moves there. Last year, October, it was around 265 Rand per share. It's currently at around 155. What's happened in the space of these few months?
Yeah, I mean, it's a very interesting one, a big knock to the share price. But just bear in mind also, Nastasia, that you go back to October, the beginning of October last year, the oil price was over $90 a barrel. It went all the way to 75. It's now climbing steadily towards the $90 a barrel mark. So two things happened. I think oil price declined, which led a decline in terms of Sasol. We've seen a turnaround this year in the oil price. We haven't seen so in terms of Sasol. They released interim earnings, which were down 19%. So I think the markets kind of were disappointed by this decline of earnings and dividends. But at the same time, I think if you were to look at Sasol earnings based on the current spot price, they are due for a very big bounce in the earnings if the current oil price remains.
Patrice, let's leave it there. Thank you so much for your time. That is Patrice Rousseau, the Chief Investment Officer at Ashburton Investments. Of course, next week we kick off with various US Fed presidents delivering speeches. That could have an influence on the US dollar. Apart from that, we're going to be paying attention to the Bank of China, the FOMC minutes, as well as the US CPI figures. We're going to take a quick break. When we come back, we'll have SME on point.